All right, welcome back to day 7 of our options trading explainer. You've already got a solid foundation with calls, puts, strikes, and expiry, so today we are tackling the big one, demystifying option pricing. We're going to break down 3 absolutely crucial concepts: ITM, ATM, and OTM. Okay, let's dive into this. Have you ever stared at an option chain and thought, why on earth are some of these so incredibly expensive, while others, literally right next to them, cost practically pennies? It's kind of baffling at first, right? Well, the answer isn't magic, and it's definitely not random. It really all boils down to those 3 little acronyms: ITM, ATM, and OTM. Once you crack these, the whole pricing puzzle is going to make total sense. So what's the secret decoder ring for all this? It's actually just one really basic relationship. Figuring out if an option is ITM, ATM, or OTM depends entirely on comparing just 2 numbers, the current market price of the asset versus the specific strike price you selected. Think of it kind of like a discount coupon. The real value of your coupon depends entirely on the actual real-world price of the thing you want to buy, right? It's simply a real-time comparison between where the market is right now and the target price you want to trade at. Let's make this super concrete with a real-life example so we can step through it together. Say we're looking at the Nifty 50 index. Imagine we pull up the chart right now, and the current market price is sitting perfectly at 20,000. Just lock that number in your head for a second. Our baseline, our current price line, is drawn firmly at exactly 20,000. All right, first up is ATM, which stands for at the money. You can think of this as our neutral center, our baseline. Let's call it the yellow zone. An option is at the money when the strike price you choose is exactly equal to the current market price. So back to our Nifty example. If the market is at 20,000 and you pick the 20,000 strike option, boom, congratulations, you've got an ATM option. You are dead center. Now, let's shift gears and look at ITM, or in the money. I want you to visualize this as the green zone. If an option is ITM, it means it's already sitting in the profit zone. It's like having a coupon that lets you buy a $100 pair of sneakers for 80 bucks. That coupon instantly has $20 of real baked-in value, right? In the options world, we call that intrinsic value. And because it's already got that built-in profit, you're going to pay a premium for it. ITM options are way more expensive because you're paying for that safety and that immediate value. Now, what's really interesting here is how the math completely flips, depending on whether you're holding a call or a put. Since they're opposites, the rules are opposites too. For a call option, you're in the money when your strike price is strictly lower than the current market price. But for a put option, you're in the money when the strike price is higher than the market price. It's a simple rule of thumb, but man, it is absolutely vital to keep straight when you're navigating that green zone. Okay, let's swing over to the opposite side of the spectrum, OTM, or out of the money. This is our red zone. An OTM option is one that just isn't profitable yet. It hasn't hit its target. Because it doesn't have any of that intrinsic value we just talked about, it's essentially a lottery ticket. You're just hoping the market makes a massive move your way. Because of that, they are super, super cheap to buy. But listen, do not let that cheap price tag fool you. That cheap price means it is highly risky. And just like before, let's quickly check the math for out of the money, because the direction flips again. To be OTM on a call, your strike price has to be higher than the current market price. The market just hasn't climbed up to your strike yet. On the flip side, for a put option to be OTM, the strike price needs to be lower than the current market price. It's out of the profit zone, and you're just sitting there waiting for a move that honestly might never happen. So to bring it all together, this brilliantly illustrates the core trade-off you're always making. ATM is your neutral middle ground. ITM is the safer bet because it's already hanging out in the profit zone, but you're going to pay a hefty premium for that safety. And OTM, it's cheap, which is so tempting, but it is entirely out of the profit zone, making it a major risk. Basically, every single time you place a trade, you're balancing these exact factors against each other. All right, now that you know the rules, we need to have a real talk about the traps. These are the top 3 beginner mistakes I see constantly, and they will drain your account fast. Mistake number 1, exclusively buying cheap OTM options just because they feel like a bargain. Mistake number 2 goes right along with that, totally ignoring probability. Those OTM options are cheap for a very good reason. The mathematical odds of them actually becoming profitable before expiry are super low. And mistake number 3, forgetting to check the relationship with the current market price altogether. You literally have to keep comparing your strike to the market, or else you're just flying blind. But hey, real understanding doesn't just come from watching an explainer, right? It clicks when you see it in the wild market. So I've got a quick, actionable 3-step homework assignment for you. First, open up the option chain on your brokerage platform. Second, pick an asset, look at its market price, and actively try to spot the ITM, ATM, and OTM strikes. And third, just look at the massive price differences between them. See that risk-reward balance with your own eyes. Before we wrap up, though, I want to leave you with a thought. If out-of-the-money options are so mathematically risky, why do giant financial institutions buy them by the millions every single day? Chew on that, and we'll uncover that exact secret together in Day 8.